Hey everyone, welcome back to another edition of What's in My Insurance Policy. Today, I want to talk about coinsurance. Coinsurance specifically in the property policy. Now, why I say specifically is because it can have various meanings and quite different meanings depending on the policy it's in. Now, this is something to always be aware of in insurance, is just because you saw a definition in one policy of a word doesn't mean it has the same meaning in a different policy. And coinsurance is a great example of this. So coinsurance we're probably most familiar with from our high deductible health insurance plans. If you're lucky enough not to be on a high deductible, let me explain really quick what it means. So you have a $5,000 deductible for your healthcare costs, which you pay out of pocket until that $5,000 is met. After that's met, you pay a certain percentage, 20% seems to be kind of common of the cost, and the insurance pays 80% until your max, until there's a max on the policy that you pay is met. So it's basically skin in the game after the deductible is met. Coinsurance in property means something much different. So for the insurance company to compel you to insure the value, they had to put a mechanism in there and to ensure that they're getting the proper rate for the exposure. Because a lot of losses aren't 100% losses. It's a lot of partial losses. The roof might have blown off. A core of the house might have caught on fire, or the building. But very seldom are they complete losses. So what happens if you're not insuring to the correct value and you have a co-insurance clause in your policy? Let's use an example. Let's say you have $1 million building is the replacement cost, and your co-insurance clause within the policy is 80%. Basically, what that means is you have to insure to $800,000 to get partial claims completely paid, minus your deductible. So let's say you have a $500,000 loss, and you insure that $1 million building to $800,000 or more. $500,000 loss occurs, the insurance company pays you the $500,000 minus any deductible. But let's use that same example, but this time you only insure to $750,000. So you're essentially under your co-insurance, your $800,000 by 6.25%. You're insuring to 93.75%, and you have that same $500,000 loss. Now, instead of getting $500,000 minus your deductible, you're going to get 93.75% of that claim paid, which comes out to $468,750 minus your deductible. So you can see that can make a big difference. So, and co-insurance ranges can vary. It can be 80%, 90%, 100%. So it's something to be very wary of and should be eliminated from your policy. It's something most insurance companies will take off, but not always. And it's a big area, especially in business income, where it's hard to predict what your business will look like in 12 months, in 10 months. You might get a big contract. Now your business income you're significantly undervalued, and you have a co-insurance clause in there. Because what they're going to look at is what's the exposure for these 12 months and what did you insure for, and if you're not insured properly, we're going to penalize you. And again, it can be waived for business income, contents, property insurance, and it should be. But you want to check to make sure it is, because like I said, co-insurance can have much drastic and much different meanings than what you might be accustomed to. I hope this helps. Please send us suggestions, questions, comments, and we'll keep rolling the films out. Thanks.